Is DGRO right for you? Pros, cons, alternatives explained here. Hey everyone, and welcome back to Chat ETF. Today, we're diving deep into the DGRO ETF, a popular choice for income-seeking investors. DGRO focuses on companies with a history of increasing their dividends, potentially offering you a reliable stream of income and long-term growth. But is DGRO right for you? What are the benefits and risks involved? And how does it compare to other dividend-focused ETFs? Don't worry, we've got you covered. In this video, we'll break down everything you need to know about DGRO, from its investment strategy to its performance and potential pitfalls. We'll also compare it to other popular options like VOO and SCHD to help you decide which ETF might be the best fit for your portfolio. So, whether you're a seasoned investor or just starting out, stick around to learn all about DGRO. Question 1. What is DGRO and how does it work? DGRO, or the iShares Core Dividend Growth ETF, is an exchange-traded fund, ETF, that tracks the performance of an index composed of U.S. companies with a history of consistently increasing their dividends. Here's a breakdown of how it works here. Index tracking. DGRO doesn't invest in individual stocks directly. Instead, it aims to mirror the performance of an underlying index, which in this case, focuses on companies with a track record of growing their dividend payouts over time. Dividend focus. The companies in the DGRO index are chosen based on their dividend growth history and future potential for continued dividend growth. This strategy targets companies with strong financials and a commitment to rewarding shareholders through regular dividend increases. Passive management. DGRO is passively managed, meaning the fund manager doesn't actively try to outperform the market by picking individual stocks. Instead, the fund simply replicates the holdings and performance of the underlying index. This approach generally comes with lower fees compared to actively managed funds. Essentially, by investing in DGRO, you're aiming to gain exposure to a basket of companies that have a history of increasing their dividends, potentially providing you with a stream of income and capital appreciation over time. Here are some additional points to keep in mind here. DGRO is traded on the New York Stock Exchange, NYSE under the ticker symbol DGRO. As of February 28, 2024, DGRO has a net asset value of over $26 billion and is currently trading at around $56 per share. It's important to remember that past performance is not necessarily indicative of future results, and even companies with a history of dividend growth can experience periods where they cut or suspend their dividends. Question 2. What are the key benefits of investing in DGRO? Here are some of the key benefits of investing in the DGRO ETF. 1. Access to consistent dividend growth. DGRO focuses on companies with a history of increasing their dividends, potentially providing investors with a reliable stream of income over time. This can be particularly attractive for income-seeking investors, such as retirees or individuals approaching retirement. 2. Potential for capital appreciation. While DGRO prioritizes dividend growth, the underlying companies also have the potential to appreciate in value over time. This means that, in addition to receiving dividends, investors could also see their investment grow in value if the share prices of the companies in the ETF increase. 3. Diversification. DGRO invests in a wide range of U.S. companies across various sectors, such as consumer staples, healthcare, and technology. This diversification helps to spread risk and reduce the impact of any single company's performance on your overall investment. 4. Low cost. DGRO is a passively managed ETF, which typically comes with lower expense ratios compared to actively managed funds. This means that investors keep more of their returns, as they are not paying high fees for active management. 5. Transparency. DGRO tracks a public index, which means that investors have full transparency into the holdings and weightings of the ETF. This allows investors to understand exactly what they are investing in and how the fund is performing. Question 3. What are the potential risks associated with investing in DGRO? While DGRO offers potential benefits, there are also inherent risks involved in investing in this ETF. Here are some key ones to consider. 1. Market risk. Like any investment tied to the stock market, DGRO is subject to market fluctuations. The value of the ETF, and therefore your investment, can go down, even if the companies within it continue to pay dividends. This can lead to significant losses if you need to sell your shares during a market downturn. 2. Dividend risk. Although DGRO focuses on companies with a history of increasing dividends, there's no guarantee that these companies will continue to do so. Economic downturns, company-specific issues, or changes in management strategy can all lead to dividend cuts or suspensions. This could impact your expected income stream and potentially lead to a decline in the ETF's share price. 3. Interest rate risk. Rising interest rates can make dividend-paying investments like DGRO less attractive compared to other options that offer higher potential returns. This is because investors might seek out investments with better yields in a higher rate environment. This could lead to a decrease in demand for DGRO, potentially impacting its share price. 4. Sector concentration. While DGRO offers diversification across different sectors, it does have a higher weighting towards certain sectors like consumer staples and utilities. These sectors may underperform compared to the broader market in certain economic environments, potentially impacting the overall performance of the ETF. Question 4. Who is DGRO suitable for? DGRO might be suitable for a variety of investors, but it's important to carefully consider your individual circumstances and risk tolerance before investing. Here's a breakdown of who might find DGRO appealing. Potentially suitable investors are income-seeking investors. DGRO's focus on companies with a history of increasing dividends can be attractive for individuals seeking regular income payouts. This could include retirees or individuals approaching retirement who rely on dividends to supplement their income. Long-term investors. DGRO can be a good fit for investors with a long-term investment horizon, typically 5+ years, who are comfortable with the inherent ups and downs of the stock market. This is because the potential for capital appreciation alongside dividend growth can compound over time. Investors seeking diversification. DGRO offers exposure to a variety of U.S. companies across various sectors, helping to spread risk and reduce the impact of any single company's performance. This can be beneficial for investors who want to diversify their portfolio without actively picking individual stocks. Investors who might want to proceed with caution. Investors with short-term investment horizons, DGRO, like any investment tied to the market, can fluctuate in value. Investors with short-term needs may not be able to ride out market downturns and could potentially suffer losses if they need to sell their shares before the market recovers. Investors seeking high current income, while DGRO provides dividends, the current yield, annual dividend distribution divided by the share price, might not be as high as some other income-generating investments like high-yield bonds. Investors seeking the highest possible current income might need to explore alternative options. Risk-averse investors, DGRO, is still exposed to the inherent risks of the stock market. Investors who are very risk-averse and cannot tolerate any potential losses might want to consider lower-risk investment options. Question 5. How does DGRO compare to similar ETFs? DGRO faces competition from several similar ETFs, each with its own nuances. Here's a brief comparison of some key contenders. 1. VOO, Vanguard SP 500 ETF. Focus tracks the SP 500 index, offering broad exposure to the largest U.S. companies. Similarities, both provide diversification and potential for capital appreciation. Differences, VOO doesn't prioritize dividend growth, potentially offering higher current income in some periods. However, DGRO's focus on dividend-growing companies might outperform VOO in the long run, especially in high-dividend environments. 2. VIG, Vanguard Dividend Growth ETF. Focus, similar to DGRO, it tracks an index of U.S. companies with a history of increasing dividends. Similarities, both target similar investment goals and offer exposure to dividend-growing companies. Differences, DGRO might offer slightly lower fees and a broader sector diversification compared to VIG. However, VIG might have a higher current yield due to its specific index methodology. 3. SCHD, Schwab U.S. Dividend Equity ETF. Focus tracks an index of high dividend-paying U.S. companies, regardless of their dividend growth history. Similarities, both offer income through dividends. Differences, SCHD prioritizes current yield, potentially offering higher immediate income. However, DGRO focuses on companies with a track record of growing their dividends, potentially leading to higher long-term income potential. Additionally, SCHD might have higher volatility due to its focus on high dividend-paying companies, which can be more susceptible to economic downturns. Question 6. What are some important considerations before investing in DGRO? Here are some important considerations before investing in DGRO. 1. Investment goals and time horizon. Align DGRO with your goals. Ensure DGRO aligns with your long-term investment goals. Its focus on dividend growth might be suitable if you seek income generation and potential capital appreciation over a long period, 5+ years. Consider your time horizon. If you need access to your money in the short term, DGRO might not be suitable, as the market can be volatile, and you risk selling at a loss. 2. Risk tolerance. Understand the inherent risks. DGRO is still exposed to market fluctuations, dividend cuts, and other risks. Ensure you are comfortable with the potential for losses before investing. 3. Portfolio diversification. DGRO as part of a diversified portfolio. While DGRO offers diversification across sectors, consider including it as part of a broader investment strategy that includes other asset classes like bonds and international investments to further mitigate risk. 4. Alternatives and fees. Compared to similar ETFs, research and compare DGRO with similar ETFs like VOO, VIG, and SCHD, considering factors like investment objectives, fees, current yield, and risk profile to choose the option that best suits your needs. 5. Professional guidance. Consult a financial advisor. Consider seeking guidance from a qualified financial advisor who can assess your individual circumstances, risk tolerance, and investment goals to determine if DGRO is a suitable investment for you.